Welcome to POTUS 2017, where we keep watch on the Oval Office and pour cold, hard facts on the overheated political rhetoric. I'm Brian Lehrer. Get your taxes in this week. About 150 million Americans met the deadline, an estimated 5 million procrastinators on the last day. Looking ahead, will the tax code be simpler and more equitable next year, as President Trump promised in his campaign? Nearing the 100-day mark in his term, Trump's plan is in deep trouble, in part because he still insists on keeping his own returns secret. Democrats are refusing to help with any tax code rewrite until they know what changes might further enrich the Trump family. And Republicans themselves are divided on the shape of tax reform. Deficit hawks on the Hill prefer that any new taxes pay down debt over funding infrastructure, say a wall. Big business is split too. The president wants import taxes to protect manufacturing at home. But corporations that rely on imports, like Walmart, are opposed. So are the Koch brothers. In the face of all this, House Speaker Paul Ryan claims not to fear another flop like the failed Obamacare repeal.
Because we, Republicans, this is in our DNA. Cleaning up the IRS, cleaning up the tax code, making America more competitive, getting jobs and manufacturing restored to America, lowering our tax rates to make us more competitive. That's something we all agree on. We don't have a schism whatsoever in our party on that. And that's why I'm confident we'll still get tax reform.
So what breed of tax reform might thrive in the swamp, and with what effect on our wallets? Joining us, Michael Graetz. He is alumni professor of tax law at Columbia University. And with us, too, is Greg David, columnist for Crain's New York Business. Greg directs the Business and Economics Reporting Program at the City University of New York Graduate School of Journalism. Welcome, both of you.
Thank you, Brian.
Greg, there's this supposed consensus on what kind of tax reform is needed that the politicians kind of agree to in theory, and most regular people don't understand. And it has to do with broadening the base and cutting the rates.
Right.
Can you explain it?
Right. So the answer to this is that we have lots of carve-outs or deductions or breaks in the tax code. The mortgage interest deduction, which benefits homeowners, is a key one. The charitable deduction, which benefits charities and mostly goes to wealthy people, is another. Those of us who live in New York or California benefit from a deduction for state and local income taxes. So the general idea is we should get rid of many of these deductions and others that hedge fund managers or real estate developers take advantage of, and that would allow us to lower the rate. So that's the theory. But what's really in the DNA of Republicans is just to cut the rates. To cut the rates, in their view, to spur economic activity. They would say that high rates deter people. It's called the marginal tax rate. And by the way, if you're a relatively rich person in New York, we're talking making more than $2 million a year, 60% of your income above $2 million is already paid in taxes. So that's the marginal tax rate. The Republicans say that discourages economic activity and investment. Let's cut the rate.
Do you want to add to that?
Well, I think the Republicans now are particularly anxious to repeal the deduction on state and local taxes, because those taxes are high in the blue states, and they're either low or non-existent in the red states.
So in New York, for example, where there's a high city and state, if you're in New York City, there's a city income tax, there's a state income tax, there are property taxes and other state and local taxes. You actually get to deduct those at your federal tax rate off your federal income taxes.
Exactly, and what that means is that if you lower the rates and you repeal this deduction, you're going to have very different effects depending on how much taxes you pay to your state and local governments. And New Yorkers are not going to like it much But as you know, in California and New York, other high tax states, there's not a lot of Republican members of Congress.
Right.
But you know, this shows how complicated it is, because the Tax Foundation just put out a study, and yes, the biggest benefit goes to California taxpayers. The second biggest benefit to New York taxpayers.
From the current system.
From the current system. But the third biggest benefit is to Texas, and the fourth biggest benefit is to Florida. I was floored when I read that.
Now, Florida has no income
And
tax,
neither does
right?
Texas, but they pay such high other taxes, and they are relatively well-off states, that they rank very high on the beneficiary list. So we'll just have to see how the politics of this play out.
But that's mostly property taxes in Florida and in Texas. And the Republicans are going to be much more reluctant to touch deductions for property taxes or deductions for home mortgage interest. They're much more likely to be happy to limit or to eliminate the deduction completely for state and local income taxes. And that's where we're sitting now in New York. That's where we'll be hurt.
As a matter of tax law history, how did the personal income tax code get this complicated with so many particular deductions?
Well, you know, if you think of it as a layer cake, we're adding a layer after a layer after layer, and then every generation there's a little subtraction. So the last time there was any subtraction, base broadening and lowering the rates, was in 1986. And since 1986, it took about 2 minutes for Congress to enact its first amendments to the tax code of 1986.
Adding some new deduction
And then, you know, we're developing a tax law by addition without subtraction.
So politically, you said it's in the Republicans' DNA to just want to cut taxes. People will certainly understand that, and they've heard it before. And Trump himself seems to have changed his language from the campaign when I think he was talking about simplifying the tax code, which involves broadening the base and lowering the rates, all of that, fewer deductions, put it on the back of a postcard. Now, what I hear him saying in his public appearances is, I'm going to give you such a great tax cut.
Yes, well, of course, he says a lot of things, so we never know what to do. But even the administration is all over the place. So his new Treasury Secretary said there would be no net benefit to rich people, that they would accomplish the lowering tax rate and broadening the benefit. But the Republican plan and everything that Ryan in the House has ever proposed would result in major reductions in the taxes paid by the rich. So where are they? You know, there's the Trump tax plan from the campaign, but the administration has yet to put anything forward that we could analyze and figure out where they are. And I think the Treasury Secretary said this week that they were not going to make an August deadline for passing anything.
Let me follow up on that for a second, because if this all comes out revenue neutral, if the federal income tax system takes in the same amount of money, then who really cares if you lower the rate and broaden the base, or if you leave it the way it is? Are the wrong people paying too little and too much taxes?
Well, it's a winners and losers game. Are you a winner or are you a loser? If they accomplish this revenue neutral by making sure everyone in New York pays more, well, that won't be good for New York. If they accomplish it by eliminating the charitable deduction, well, nonprofits will say this is disastrous for us, for it's a winners and losers game. Now, there's one other key in the politics of this, and that is they can't get 60 votes for tax reform or cuts in the Senate. So they have to do a tax bill through budget reconciliation, which means it can't add to the deficit over 10 years. So that's a limiting factor on them, and they have to come up with some way to meet that test.
So then it couldn't be just a tax cut that defunds the federal government.
It couldn't be under reconciliation.
Well, it depends on their budget. It depends on their budget explanation, what they tell the committees to do. But there is a rule that says in the years after 10 years, the Senate needs 60 votes in order to pass anything. And that's why the Bush tax cuts, which cut the first 10 years dramatically, expired at the end of 10 years, even though, as we know, most of those cuts stayed in place. Obama got some of them reversed, but not all of them. So you can cut taxes for 10 years, but you have to sunset it.
You know, that's why the failure of the health care bill affects the tax reform issue, because they were going to actually generate $1 trillion in reduced spending that could have been used for tax cuts, and they don't have that $1 trillion anymore.
Let's talk about business taxes. You wrote, Professor Graetz, that the reforms proposed in the House Republican blueprint are not really reforms, but a repeal of corporate tax. But as a starting point, pretty much everybody agrees that American corporate taxes are too high relative to other countries. I mean, Democrats and Republicans in Washington largely agree on that, don't they?
Everyone, I think, in Washington and elsewhere agrees on that. We've got a system now where we've got the highest statutory tax rate, 35% on corporations in the world. And that gives companies an incentive to do one of two things. One is locate all your deductions here and put your income in a low tax or no tax place, or to change the headquarters of your company so that it's a foreign company and not a U.S. company, because we're the only country that's now taxing worldwide income at some point. Everybody else only taxes their domestic income. So there's a lot of agreement on the need to do both of those. We also, of course, are taxing corporate income at 35%. We're taxing individuals who are not going to move and not going to move their income at 20% on their dividends. It's just backwards.
How did it get like that politically, Greg? One would think that with corporate clout in Washington, that we wouldn't have the highest corporate taxes in the world or among it.
Well, I would say there isn't that much corporate clout, and in that sense,
that's another show.
Well, and then in the sense that fixing it has to do with very difficult lines to cross. This territorial issue, which you mentioned, which is really significant. The United States attempts to tax Apple's income all over the world, but Ireland would only tax the income in Ireland or in Germany. So that creates all kinds of incentives. But then we say that you don't get taxed until you bring the money home. So this means that there's more than $2.5 trillion of American profits sitting overseas because people won't bring it home. You know, I was very taken. There was this major 60 Minutes interview with Tim Cook about 1.5 years ago, and they brought the issue up to him, and he said, I'd bring it home, but I'm not bringing it home at 30%. I'm not bringing it home at 20%. You got to give me a rate that I think is fair to bring it home.
That's Tim Cook, the CEO of Apple, yeah.
And what Tim Cook, the CEO of Apple, did, of course, was he borrowed money in the United States, took interest deductions against the corporate taxes he might have paid in order to pay dividends to his shareholders.
So here's a vocabulary word, repatriation.
Yes.
Can you define it and tell us how it applies to the Apple situation we were just talking about or others?
Repatriation is simply that the corporate tax that the U.S. imposes is imposed on the difference between what your U.S. rate and your foreign tax rate is. And so if you've got money in Ireland, say at 12.5%, or even in Bermuda at 0%, if you bring it back to the United States for investment in the United States, some of it may be in U.S. banks, which is a different matter, but if you bring it back to the U.S. and want to invest it in the United States, you have to pay the difference between that 12.5% and 35%, or you have to pay the difference between 0 and 35. If it's 25% and you've got $2.5 trillion, as Greg says, sitting offshore, there are a lot of taxes that are being delayed by keeping the money offshore, and we've created an incentive for U.S. companies to buy foreign companies instead of U.S. companies, and for them to invest abroad rather than investing in the United States.
So is there a way to do this? Is it a one-time tax break to bring money back? Or?
It's possible. We did that once before, and the benefits were not so great. Look, what we said is bring it back and invest it and create jobs, and this will be good, and people didn't really do that.
What did they do? They kept the dividends?
Yeah, they kept the dividends, or they kept it in profits, or you couldn't prove that they were invested.
There actually is the research on this is actually quite complicated. The old view, if I can put it that way, is that they never did any investing. The new view is that the big companies did more investing in the U.S. than was thought, but a lot of it went into stock buybacks and payments to shareholders. But it's not like it disappeared. And it was several $100 billion that was brought back on a tax holiday in 2005 when you could pay 5% instead of paying the difference between the U.S. rate and the foreign rate.
Now, you could get this to happen politically because it can generate a lot of money. I talked to someone who's been an expert on a lot of this, who thinks nothing's going to happen on taxes except some sort of repatriation deal, either as a one-time thing or as part of a lower tax rate, which will generate enough money to at least do an infrastructure program. So there is enough agreement that we can get some sort of deal on corporate income taxes, or at the very least, we're going to get some sort of incentive to repatriate a lot of money.
And Trump is actually hinting at that when he gave his Hire American, Buy American speech in Kenosha, Wisconsin this week, where he was saying, yeah, maybe we can get some kind of deal on taxes when we match it with some other things that people want. And he was just hinting at it, but he seemed to signal, at least to political reporters, if not to the tool makers in the audience, that there may be some, political deal in the works that would include some kind of tax reform.
Well, the House chairman of the Ways and Means Committee, before the current chairman, came up with a classic solution to this, which is to impose a tax on that $2.6 trillion that's sitting offshore, and then just to count the revenue twice, spend it once on infrastructure and spend it once on lowering the corporate rate. And that's a standard operating procedure in the Congress.
So it's fraudulent
you can count it. You can count it for any number of things.
What about the import tax? This is a Trump economic nationalist thing. Paul Ryan seems to be interested in it too. We don't tax our exports, but to protect our domestic manufacturers, we tax imports, at least under certain circumstances.
Well, not under current law. Under current law,
that's the proposal.
Under current law, we're taxing the income wherever it's earned, and we're giving companies like Walmart or others who have a lot of imports a deduction for the cost of their imports. We're just taxing their income. Under the Ryan-Brady plan, Brady being the chairman of the Ways and Means Committee in the House, Brady of Texas, right? Under that plan, what we would do is exempt the income from exports and allow no deduction for imports, which means, of course, that exporting companies like Caterpillar or GE, would pay no tax forever. They'd have losses as far as the eye could see and basically pay no tax to the U.S. And companies like Walmart would pay a lot of tax unless, and this is what Brady and Ryan say, it's what some economists say, the financial economists are much more skeptical, unless the value of the dollar changes, and those imports then become much less expensive. And the idea is that if you impose a tax, as Ryan and Brady have proposed, at 20%, the price of imports will fall by that 20%. And Walmart will be just as well off, but Walmart's not buying it
to buy those imports cheap. So
somebody went to I talked to went to a session where Ryan tried to explain it, and he walked away saying not a single person in this Washington audience understood it, and therefore he could never pass because he can't explain it and no one understands it.
But it makes some intuitive sense to a lot of people who voted for Donald Trump and who want domestic manufacturing protected. So do you think that it would even have the desired effect? That is, would it make it harder for companies to, say, move jobs overseas and then sell the products they make back to us than it's been under NAFTA and other recent year agreements?
I just think it doesn't work, and it's not. The only thing, if you want to do this, you do this through tariffs, right? You put in tariffs to raise the cost of imported goods.
What's the difference between an import tax and a tariff?
Well, the taxes are very complicated and indirect effects. If you want a direct effect, you impose a tariff on the goods coming in to make them more expensive. I don't think any tax proposal in this way is going to survive because they're way too complicated. And my head hurts when we go from, it's hard enough for me to get as far on the import tax issue as understanding how it works, and then going to, well, that's going to change the dollar, so it's going to offset. And when I hear people predict where the dollar is going to go in reaction to a single event, when the dollar's strength or weakness is based on so many factors, strikes me as the law of unintended consequences we don't know. So I will be very surprised if any attempt survives in Congress that would seek to do this, that would threaten to raise the price of goods in a Walmart. It's very hard to sell politically, I think.
Well, I don't disagree with you that it's hard to sell politically because you've got a lot of opposition to it. But I think it's very important to understand what they're trying to do. And what they're trying to do is they're trying to impose the tax where goods and services are purchased or sold rather than where production occurs or where the company is headquartered. So that if it did pass, and value-added taxes work this way to some extent. This is not a value-added tax, but it's close.
Like a national sales tax.
Like a national sales tax
have, instead of an income tax.
Exactly, and they exempt exports and tax imports, and 167 countries do it. So it's not like it's an idea that doesn't exist. The key is that for them to do it in the way they're doing it, which is unlike every other country in the world, it's a unique tax that doesn't exist anywhere because of the way they've structured it. For them to do that creates a whole series of uncertainties, one of which is what happens to the dollar. And it's not at all clear what happens to the dollar. And if the dollar doesn't rise by the full 25% that it needs to rise, then prices have to rise or wages have to drop. There are only three things that can happen. Walmart and the Koch brothers and oil refiners are worried about what happens to the price of the pump and to the price of their goods when they sell them. On the other hand, the exporters would be very happy with this result, and so you've created a political, this is why I agree with you politically, that you've created a political tension between the exporters who are the winners and the importers who are the losers, and they may well block this idea.
Let me touch one other thing before we run out of time. Trump got elected as this anti-free trade president who was going to protect American manufacturing. Now, there was a big flip-flop by him in the news when he declared China not a currency manipulator after all. I think the consensus is that he was lying in the campaign anyway because China had already stopped manipulating their currency. So now he found an excuse, which was North Korea, to state reality because he wasn't going to impose that status on China and pay the consequences. But also making much less news is an indication that he's only going to tweak NAFTA around the edges and not try to get out of it or overhaul it. In fact, Iowa Senator Joni Ernst, Republican, said at a town hall meeting the other night, NAFTA is really good for Iowa because we sell so much Iowa corn to Mexico. Who outside of Iowa realize that we sell corn to Mexico? But where does this stand, and what does it say about Trump's campaign?
I taught my globalization class last night, and we ended on this, and the bottom line at the moment is Trump is wimping out on trade. We are 100 days in, and he has done not one significant thing on trade. Not one proposal, not currency manipulation, not a tariff. Remember, we were going to get immediate tariffs against China.
What about that announcement this week in Kenosha, an executive order having to do with government contractors, American contractors getting preference And hiring Americans rather than H-1B visa holders?
Well, there are two separate issues to this. There's, yes, making it a little tougher or easier for American companies to bid for government contracts, not compete in the marketplace. And two, setting up a commission to investigating the H-1B visa program, which some people say is filled with fraud, and most tech companies say is crucial to bringing people they need to America. And as Chuck Schumer said about executive orders yesterday, they don't do anything on their own. They are just setting in motion a process to do something. There was nothing significant in Kenosha yesterday.
He's going to have to go to Congress and start this whole complicated process that you were just describing, how complicated it is with tax reform, over again on that. And that, unfortunately, is where we run out of time. Thank you both so much.
Thank you.
For your wisdom and thoughtfulness today. And that's POTUS 2017 for this week. We are here each week at this hour pouring cold, hard facts on the overheated political rhetoric. I'm Brian Lehrer. Thanks for traveling this long and winding spreadsheet with us today.